Hello. Hey Tony. Hello. Welcome. Welcome to the Smart Money Stoics. This is actually um the first live in English. I am part of this community, John Fibonacci. I say community in YouTube called the Smart Money Stoics, right? And I I am a student of his, and I was funded on June this year. So I'm very happy to be able to give back, and I'm very excited actually that you're here and that we can connect, Brian. So welcome to the stream. Um, I wanted to start off with saying, smart money uh, concepts or smart money stoics. It's not, mine. It's uh, it's for the people. John made it very clear that it's people over profits. So I'm going to start sharing um, all these concepts, and I'm not gonna hold anything back. You can ask any question, like the video, subscribe, and obviously invite someone that you like, respect, or trust that you think that will find value in this YouTube channel. So thank you a lot for being here. Um, Brand. So Tony is your second name? I I I didn't know. There's a little lag. Well, not lag bad, but I say something and then you hear that maybe like 15 or 20 seconds after. All right, so even before talking about anything, I wanted to share with you a little bit of the mindset that implies to be a smart money trader. Um, there's a reason why I asked you to start off with the book. Brian, Tony, perfect. I Tony, I have three family members that are Marco like me, and then their second name is Tony actually. Uh, it's kind of interesting. But yeah, we don't just trade, and we don't use any indicator. There's a mindset that goes with it. There's an understanding, um, even before understanding the markets, right? Even before understanding how the market operates. The book that I let you guys to read or listen, Trading in the Zone by Mark Douglas. It's a book that you have to read even before you get to the charts because it's about psychology. Mark Douglas is a world known, or I'm sorry, rest in peace, was a world known um, trader and coach. He coached people from all ranks, in all floors, in all kinds of markets, and he did a great job on psychology and technical analysis. And this guy says that the number one reason why people lose money in the markets, it doesn't matter the size of the trader, the reasons remain the same. And the reason he shared is because, um, oh damn, I have, I'm sorry. Can you see me now? Sorry about that. The number one reason, Tony, sorry that I wasn't, here with you. I didn't notice it. I apologize. All right. So number one reason why people lose money in the markets is because they start off the wrong reasons. They start off with the wrong reasons and the wrong expectations, and therefore they commit every single mistake on the book. and they never really mature, emotionally, or develop the beliefs, or even develop the skill to think in probabilities, you know? So for this reason, it's very important. It's very important um, to understand that the market it's abundant, right? The market it's abundant, and the opportunities are infinite. So it could be a really big psychology gap to fill. Give me 1 second. My my girlfriend just got out of work and she doesn't know I'm live, so I'm just gonna give me 1 second. Hola, amor. Hola. ¿Viste mi mensaje en WhatsApp? Oh, ok. Estoy live. No, no, no te preocupes. Con cuidado. Te amo. All right. And sorry about that. And you know, a lot of people compare this uh with gambling or with poker or with blackjack or Texas, with gambling basically. And Mark Douglas makes a very good point. You cannot compare this to gambling because in gambling there's a beginning, there's a middle, and there's an end. There is chips, there's turns, you can raise, you can pass, you can fold, you know, there's kind of like stops and turns, right? So there's options in a sense. It's limited, right? You cannot lose more than the chips that you put into the game because the ones that you have in your hand, those are not even in risk, right? That's in poker, that's gambling. When you come to the markets, there is no start, there is no middle, and there is no ending. The market it's abundant and it's ever it's nonstop. It closes and it opens, sure, but it's still fluctuating. It's just we cannot, access to it, but it's still operating. It's still fluctuating. So in this sense, there is no turns, there's no start, there's no middle, there's no beginning. And you can potentially lose more money, than what you have in your deposit if you are trading with leverage. So if deposit $1,000 and, you know, right off the bat, trading with $1,000 in the futures or in the forex market, you are using leverage because otherwise you wouldn't be able to open a, a position because you would need at least 10,000. So if you're trading with $1,000 right off the bat, you are using leverage. And when you use leverage, you are putting in risk what you deposit and more. Because when you open a position using leverage, you are basically being able to make or lose more than what you should be able to with that capital. That's why it's called leverage. So, with this understanding, if you're trading $1,000 with leverage, you can end that account with negative $4,000. So how does that compare to gambling or with poker or with blackjack? It cannot be. So it's more difficult. This is I'm not gonna say, oh yeah, you should be trading. It's super easy. No, it's the hardest thing. 95% of people lose their money in the markets. Like, this is not an opinion. This is a fact. This is a known fact. Brokers have to disclose to their customers that they are entering an environment where 95% of people lose their deposits or more. So you are talking about that 3 to 5%. You're talking about major leagues. You're talking about NBA, NFL, you know, baseball. I don't know what's the name of that league, M something. But you know what I mean? Like, you're aiming to be the 5% that makes um consistent money. Because there is a big difference between making money in one trade and being profitable. So, and this takes me to the number one. This one. I do not need to know what is going to happen next to be profitable. It does not say I do not need to know what is going to happen next to make money. It does not say that. It says I do not need to know what is going to happen next to be profitable. What does this mean? It means that the mentality, the mentality of trade by trade mentality, that mentality is the plan to failure, because when someone trades with the trade by trade mentality, it's about making money right now. And the problem with that is it's already starting with the wrong expectation, because the market doesn't care what you need. The market doesn't even care that you exist, and anything can happen. So it's not about this trade right here. It's about a series of 2 weeks or 1 month worth of trades, and then taking out your percentages out of that to then start working your risk parameters to be profitable. So it's data that you're going to study on yourself. Do you have any before I continue, do you have any comments, any question, anything that you would like to say? Because this one is a one-on-one. It's gonna be recorded, anyone can see it, but it's basically a one-on-one, Brian. Drop a one on the chat, Brian, if you're getting value so far, so other people can see. Drop myself some love. Is this all good? I see you going, bro. I'm with you. This is all good. So no questions. All right. So we do not need to know what is going to happen next right now to be profitable. Anything can happen. Therefore, I think in probabilities. And the reason why this is here is because every moment is unique. This means every moment is truly unique and unrepeatable. Every earthquake, every storm, every uh, you know, Look at everything that nature um, leaves behind. It could be similar, but it will never be the same. There's billions, I don't know if 6, 7, or 8 billions of people on Earth. We could be very similar, but everyone is unique. We are unrepeatable. So if that is the nature of the world we live in, why would the markets be different? So with that understanding, anything can happen. Because even if the context or the environment it's very similar, every moment is unique. This means that every moment is truly unique and unrepeatable. So even if, oh, I just took a trade that, it was successful and I'm looking at the same exact setup. So you think it's going to be a winner just because you took a similar trade that was successful. So now you put more risk into it. You stop thinking in probabilities and now you're thinking emotionally. So I am a successful, disciplined, and humble trader because I respect the market. It's great. I enjoy the process, the lessons, and the profits. I honor the responsibilities that implies being a successful trader. This means respect your time, respect your money, and respect the market. I am always a student. The market is changing. You are changing. Times are changing. So why would you stop, being a student? You know, no one ever gets to perfection. Rather, I heard one time, practice makes permanent. You don't want to be perfect. You want to make it permanent. You want to be able to be consistent and, make something out of this. So being humble takes you to always being a student. The moment you stop being humble and you stop being a student, you will lose. Because you will start entering a place of emotions and false self worth or false self esteem. I know how to determine the direction of the market, and I have a methodologic technique that lets me trade seamlessly in and out of trades. I know my pronunciation is not the best. I'm gonna say it one more time, a little bit slower. I know how to determine the direction of the market, and I have a methodology. I put this as if it was English. I mean Spanish. Should say a why. I know how to determine the direction of the market. Sorry for the dyslexia. I know how to determine the direction of the market, and I have a methodology technique that lets me trade seamlessly in and out of trades. And I will teach you that. Not a financial advice. I'm not a financial advisor, you know. Um, I'm not telling you to trade real money. I have to say to disclose, I'm not teaching you to trade real money. I'm just sharing my opinions, and the way that I think and the way that I trade for entertainment purposes. All right, this is not a financial education class. My risk management is set according to my rules because, we think in probabilities. I have a step, I have a set of steps easy to execute. And lastly, I trade for risk to reward, not for money. And this last one, it's basically the same one as the first one. The last one, I trade for risk reward, not for money. It's another way of saying I do not need to know what's going to happen next to be profitable. Because when you have the correct risk to reward ratio, it doesn't matter when you lose because it's not if you're going to lose, it's when you're going to lose. It's about losing on your own terms, not on the market terms, because the market is abundant. So you do not want to lose on the market terms. You want to lose on your terms because guess what? You will lose. So with that being said, you know, don't take this for granted. Read it one time, you know, read it again a year after, read it again 5 years after. It's my 8th year and I started this book again. So don't underestimate it. You will understand and give it a new approach every time you read it. Right? So how do I start trading the market? I'm going to share the trade that I took. Uh, so, sure. All right. It's timestamps and everything because you cannot make this up. All right. So I'm going to walk you through. First of all, we start with a trader affirmation, the successful trader affirmations, we just did. So now we start with the right intentions. We start with the right mindset and with the consciousness in its right place. We now know who we are. We now know who we are not, what we want, what do we don't want. Sorry for my English. So there's no confusion, right? You know exactly what you're here for. All right. So check mark, successful trader affirmations. I know it's spelled incorrectly, don't worry. Intention and consciousness. Make sure that you're here for the right reasons. Make sure you're not here in fear. Make sure you're here not needing the money to pay something. Make sure you're here with the right intentions and consciousness. Be aware of the economic calendar. This is the one I use. It's free, and it lets you know what kind of day or events or what who's gonna talk if it's politics, um, if it's going to be about interest rates, if it's going to be about unemployment, or maybe someone in the Federal Reserve is going to talk, and that's impact. Thank you, Brian. I love that you're loving the lecture. And let me know if you have any question that crosses your mind, please. I this is awesome. The Spanish lives, they had like 10, 15, 20 views already, but no one saw it live. And this feels amazing. I'm not gonna lie. Uh, I'm very happy that you're able to be here, and it motivates me to even put more effort. So be aware of the economic calendar. You know, if you're gonna trade something in specific, be aware of, you know, what's gonna happen on a particular market, right? So if you're gonna trade something that has to do with the dollar, everything has to do with the dollar. So you consider this red carpet events of the dollar. You know, if you're going to trade gold, you want to be aware of Canada. If you trade the, you know, the Great Britain British pound, you want to be aware of, you know, what's going to happen with Great Britain's events. Unemployment claims on the 27th at 5:30, so 1 hour prior to the New York Stock Exchange open. FOMC meeting. This kind of meetings usually also um, impact a lot the market. So you want to be very aware, and you want to trade afterwards because you want to first see the intentions. Um, but yeah, nonetheless, economic calendar, be aware of it. Time, price, context. This is important. Time, price, context, and I will show you. Look. So this right here is what we're doing. Ignore the dates. This is what we're doing today. Let me put this a little bit smaller because I'm going to start charting the charts. All right, so this is what we're doing right now. Next live in English, I will be talking about risk management and top-down analysis. Next, after that, I will be talking about efficient and inefficient price and liquidity. That will be the third class. And the fourth class, it will be time, price, context, and psychology when trading the markets. So don't worry if you don't completely grasp the ideas. It's not meant for you to understand at your first stream, but you know, be consistent, take notes, and then apply that information into your practice, and make sure you don't miss these classes. And if you cannot enter a live, don't beat yourself up. The videos will be here recorded. So time, price, context, trend, liquidity, imbalances, and then mitigation models, invert imbalances, etc. All this would go together. And I'm going to show you everything. All right, so the trade that I took, I entered on 59.50 on 3:13 a.m. All right, so I'm going to zoom out a little bit. I'm going to put 3:13 a.m. Go. And then I'm going to mark London open. There you go. and then I'm going to mark New York open. I'm going to mark as well a set of low resistance lows left on November 21st on the New York session. So this is the first thing that my eyes went to when I was looking at this market is, first of all, we're in a uptrend, right? That's like undeniable. The market is going up like since a long time. We're talking about S&P right here. So it's a bullish market. It's a very, very bullish market. And we were in all-time highs very recently. And so I'm basically waiting the market to go up here. Well, actually, I didn't want to do top-down analysis, but I'm going to do it real quick. Basically, I was waiting for the market to fill out this gap on the daily. That is right here. This is my first objective, and then second objective is this set of low resistance highs. So that was the thought process behind the longs, behind why I was looking for buy opportunities, is because we had this gap and I was waiting for the market to fill it. So I'm going to go back to here. So we established that the market is bullish, and you have an upside target, right? So this is the first thing that I established, is this set of lows. Another thing is this imbalance. There's one right here as well, but don't worry about it. You will understand why I use this one. And I just extend this, and I extend it, and I extend it. So I'm going to explain you something real quick before I continue. The market, when it does, this, it's efficient because you know how it's behaving, like it's being efficient, but all of a sudden it just goes up and then up, and it's inefficient, meaning it's unbalanced. There's only buyers here, so it literally leaves an imbalance, and the market needs to come back to make price efficient again to continue. There will be one stream just about this, so don't worry. I will explain in more depth, but I just want to go with the flow right now to put in I want to show you what you are going to be able to do with what I'm going to share. There's another very clear example right here. There's an imbalance here, and even right here, you see how there's an imbalance left open. Market trades into the imbalance and then reacts off of it. So basically that's what I'm just trying to why I'm looking at this imbalance. So two things, we have liquidity. There's liquidity right here. It's a New York Stock Exchange low resistance lows. I'm just gonna put a New York Stock Exchange equal lows. All right. And the reason I put A and not D, New York Stock Exchange November 21st lows, it's because the low of the New York Stock Exchange open is this right here. This is the low. Right now, I'm looking at a low, a set of equal lows. All right. So I was looking at this, and then I was in midnight. I saw the market open, and I saw this set of low resistance highs, and I just saw the market traded lower and left those open. Even if I extend this and use this high, it's still a set of low resistance highs in a bigger time frame. So this is like a magnet, right? There's a liquidity pool above here. So I like the fact that we left it like here, like this, because it will be the upside target. Now I was waiting for the market to take this liquidity, fill this gap, and then go to the upside. So this is what I saw live. I saw the market touch the imbalance, react off of it, but it left behind a set of equal lows, and that is suspicious. That is suspicious. Why? Why is it suspicious? Oh, sorry. Because we smart money, we know that the market algorithm or the banks or institutions, however you want to see it, they engineer liquidity to fill out orders in the other side. So basically, they are enticing people to long the market to then take them out. You see? So I saw that live. That happened at 2 a.m. And then I said, okay, now I'm just going to wait because I want to trade this imbalance on the way to liquidity. Took low. So it took the low. So this imbalance on the way to liquidity, if I see this imbalance right here be unrespected, then it's bullish for me. So I saw the imbalance, and then I saw the imbalance be respected some way to go lower, like a reaction lower, and then I saw the imbalance being unrespected and traded through it. So when I saw this, I said, perfect. Now I have an inverted imbalance and a regular imbalance together. So as soon as the market comes back to that, I'm longing. And that's exactly what happened. So I cannot make this up. The entry was the average filling price at 313, 5950.5. 5950.5 at 313. My risk was at this low because manipulation usually is the low. And then we had now efficient price here. So there is no reason for us to come back to this low. And that is the reason why it's the risk. And obviously, like I shared in the beginning, I wanted this high as objective. So I go to the exit or the closure, and the limit price or the average filling price of that limit, which is the opposite, selling the buy position, it was 5975.5. 5975.5. 5975.5. I didn't even wanted the highs. I just wanted us to go up there. I was asleep when this happened because once I took the trade and I set the risk, I went to sleep, to be honest. My mentor will be very disappointed in me because I went to sleep. He says that's stupid because you cannot manage a trade sleeping. Nonetheless, it went straight to TP. So in the future market, when you're talking about E-minis, right? On a micro contract, it's $5 per point. In a mini, which is a regular, it's $20 per point. It's a micro contract and a mini contract. So you're talking about um what did I do with this trade? Oh, okay, I remember. I took two contracts, and then I remember what happened. So he's not gonna be that disappointed in me because I took two contracts. I exited one here, and then I put my risk in break even, and then I went to sleep. So those two trades together was like 1,500. You're talking about 8 points per 20. No, it's not. It doesn't count like that. So 20 times 80. Yeah, no, it's not. It's not like that. This is 8 points. No, so every 25 cents, it's a point. I'm sorry. So it's 8 times 4, it's like what, 24 points times 20. So it's $500 here. I'm sorry. It's $500 here. And then it's another $1,000 here. Because I traded 2 minis. I'm not sharing this to brag or to impose anything at all. I'm just showing you what can be possible. You know, not a financial advice. I'm not telling you to risk anything or to trade your real money. I'm just sharing you how I think and how I trade the markets. So this was the time of the trade. This was London open, London highs is the objective. Because it's the London open high. And we took New York Stock Exchange session equal lows left on November 21st. And we reacted to the upside. We took liquidity one more time. And we were trading into that inverted imbalance on the way to liquidity with the objective of the opposing liquidity. So don't miss these sessions because, like I said, it's practice, it's understanding, and you know, make those questions and make sure that when you start to learn these concepts, that you go off and make sure that you practice this 1, 2, 3, 4, 5, 6 hours a week, the most that you can. All right. Do you have any question, Brian? Yes, sir. Applied knowledge is power. But yeah, I agree. You have to know it, but don't just, you know it and hold back the information. Go ahead and apply it. Um, you know, don't rush into things. I want you uh to practice with demo. And the ultimate goal is I cannot make any guarantees because this is not a financial advice, you know. But my goal here is to help other people through my experience and and the opinions that I share here and the concepts that I share here is to help people get funded. You know, that's the goal. It's to help people that really take this serious to get funded. It's people over profits. I don't need your money. I I want you to be successful. So, you know, I'm not Top Step. I'm not getting paid. This is not a paid sponsorship. This is me following the steps of my mentor. He helped me with any guarantees. I trusted him and I got funded with my effort and my results. Obviously, I give a lot of credit where credit is due, but at the end of the day, you will be behind the screen. You will be the one, making the trades. You will be the one doing the risk management. You will be the one that will be, pressing buttons. So don't miss out, and join us, share us, like us, subscribe, and thank you for being here, Tony. You have my phone number, and you can text me if you have any questions in regard to the session. See you until the next one.